My request to all the people who are outside, we are about to start the event. May I request all of you to be here inside the hall? Good morning to all of you, and welcome to Cafe Mutual IFA 2015. I'm happy to share with you that today we will have IFAs from over 35 cities from all parts of the country here for this event. The theme for today's event is building your business for a better tomorrow. So, to help you build your business for a better tomorrow, we have lined up some of India's best regarded experts to share their insights with you. The idea is that you should be able to walk away with actionable ideas and insights. I'll share a few tips with you to make your day productive. The first thing is your batch has the agenda on the reverse. So, take a look at it and go through the agenda. To maintain discipline, time discipline, what we will do today is to circulate chits among you. So if you have a question, you will get a chit and you will have to write the question on it and pass it to one of the ushers. And we will moderate and decide which questions have to be asked to the speaker. So this gives everyone an opportunity to ask questions, and we will choose the ones which I think are the most relevant for this audience. Cafe Mutual has been approached by IFAs time and again to partner with them on investor awareness events. So today we have set up a special stall which is in the main lobby. My colleague Fauzia is sitting there. So any of you who are interested in joining the Cafe Mutual Investor Awareness Movement can please share your details with Fauzia, who is in the main lobby. Our events not only provide you knowledge, but these are great places for you to network with your people. So make new friends and meet old ones. And should you require any guidance or assistance, do not hesitate to ask any of the Cafe Mutual team members. They'll be happy to assist you. Have a great day. Make yourself comfortable. Have a great day. And now I'm happy to invite Prashant Jain for the first session of today. Friends, Prashant is actually known to all of you. But there are a few things which are perhaps not so well known about Prashant. First, he's perhaps the longest lasting fund manager in the same job. He's been in the same job for over 20 years. Okay, so big round of applause for that. But that would have been of no consequence if it had not been productive. But man, it has been too productive. He's been through more market cycles than any other fund manager. And in spite of all these market cycles, he's been very consistent. And that's a record that very few fund managers globally can boast of. So without much ado, I invite Prashant. Prashant will talk about, he'll give you a perspective on equity and debt markets. Welcome, Prashant.
Thanks, Prem, for a very nice introduction, and thank you very much for being here so early in the morning. Let me just share with you some thoughts on the economy briefly, then on the equity markets, and finally on fixed income markets. I think these are some of the changes that are taking place in the economy, and a lot has changed in the last few quarters. So this is a synopsis of what all has changed. Commodity prices have collapsed. Growth prospects of India are clearly improving. They were always very strong, but last few years we have seen some concerns. I think those concerns are now receding. We are probably looking at a current account balance or even a current account surplus next year. The fiscal impact of lower oil prices is very significant. It has not yet been much appreciated. I will comment on that. We are seeing very impressive, very quick policy making traction. So share with you one or two examples. And finally, some thoughts on the equity and fixed income markets. So this is a chart on the left, gives you how commodity prices have behaved over last 13-14 years. And you can see that commodity prices went up almost 4 times from 2000 onwards. And this was called the commodity super bull run. I think that's coming to an end now. And all commodities, agricultural, industrial, energy, all commodities are moderating. And this is not a technical sell-off like in the Lehman crisis. This is driven by more sustainable factors, by like improving supply and stable or weak demand conditions. I think China, which was the biggest driver of commodity prices, if you look at the table on the right, almost 90% of the growth in demand in iron ore and bauxite in last 10 years was driven by China alone. So as China slows down, the demand conditions are likely to remain quite weak, and this is extremely positive for India. I think the oil prices are of maximum importance to India, and we have always said, even at the time of Lehman crisis, we said US GDP growth matters less to India, and what matters more to India is our oil prices. And oil prices are coming down, and what is happening is stable. At the bottom right, you will see the US oil consumption is not rising even over 10-15 years. So what is happening, if you look at the two small charts in the middle, the mileage per gallon is improving consistently, and in US for the first time cars are being driven less. Whether e-commerce is driving it or working out of home is driving, we don't know, but the miles per car is falling in US. So US, which is 25% of the world's energy consumption, is not experiencing any growth in demand. On the other hand, if you go to the table at the top, you will see the shale oil production in US continues to rise. So oil markets are quite well supplied, and this is without Iran's oil coming into the market. Whenever the sanctions on Iran are lifted, as and when, that is additional supply. So oil may bounce $10-20, but I think it is unlikely to go back close to where it was last year. Our last year's average import price was $107 per barrel. So we are quite far away from that. I think this impact of fall in commodity prices will impact different countries differently. And the countries in the red will suffer severe economic setbacks. And those in the green are going to benefit. So countries which are large producers of commodity prices like Russia, Middle East, some African countries, they will experience extreme pain, and we are aware of what is going on. And you can see that India's exposure to commodities is one of the lowest in the world in terms of GDP percentage. So the impact of this is likely to be minuscule. In fact, if you look at India's imports to GDP of oil, they were 5% last year. So last year, Indian imports were 5% equal to GDP, 5% of oil. Now at $107 a barrel, today oil is $60. So your prices have become half, which means we will save 2.5% of GDP in oil imports. Our current account deficit was running at 1.5%. So I think that current account can be near balance, it can be in surplus. And India is one of the biggest beneficiaries of oil fall, because our oil imports to GDP is one of the largest in the world. And I don't think the importance of this can be overemphasized. The economy is clearly recovering, and we can see every year the growth rates are higher than the previous year. And current year growth is likely to be between 5.5 to 6%. Next year, RBI governor says close to 6.5%. Last year was below 5%. So GDP growth is clearly moving up. Inflation has come off from 11-12% to 4 to 5%. The current account, as I shared with you, should be near balance. 10-year bond yields are down already 100 basis points, 1.5% from the peak. We think they should fall more. And the economy is showing some signs of further recovery. So if you look at the truck rentals, they have bottomed out, they are beginning to move up. They are a lead indicator of economic prospects going forward. Because if demand for economy picks up, then first thing you do is to need more transportation. And the CDR, the upgrades to downgrades ratio is now trading above 1, is now above 1. So if the chart at the right gives you the ratio of credit upgrades to downgrades. And this ratio was below 1 until FY14, which means there were more downgrades than upgrades. But last year onwards, current year onwards, you will see that the upgrades are more than the downgrades. So probably the credit cycle should also improve as we go into next year. I think this is one note we had circulated to everyone a few, I think, months back, that the oil price fall is impacting India with a slight lag because we get 4 to 6 weeks credit on oil purchases. But from current quarter onwards, we should see the benefit of lower oil prices. And if you look at the last row, our current account deficit was about 1.3% for last few quarters. And the saving on oil is 2.5%. So that's why we feel current account in India should be near balance, or it can even be in a small surplus. So our reserves are going up quite nicely. So I think there should be no concerns. In my opinion, chances of rupee depreciating are extremely remote. Rupee actually should have some upward pressure, appreciation pressure. This is, I think, has been less commented upon. There is a very big fiscal impact of oil prices also. And the lower oil prices help the government's fiscal deficit in two ways. One is by lowering subsidies. So next year government subsidy share could be down to very, very low numbers. And you save about 0.2, 0.3% on account of that. And what has also happened is the government has increased the taxation on petrol, diesel. Excise rates have gone up. So the fall in consumer prices is less than the fall in global prices. And the impact of that you can see is quite significant on the revenue side. So about 0.5% of GDP's equivalent taxation should go up. So net we think next year oil itself will help the fiscal deficit by 0.7% compared to a 4% fiscal deficit in the current year, which is a very significant, very material number. And our finance minister has reiterated recently that he stands by the target of 3% fiscal deficit over, I think, next 2 or 3 years. So I think outlook on fiscal deficit is also quite good as we go into next year. This is what I was telling you earlier, that India is probably the best placed economy in the world right now. So the long-term drivers, of course, we have one of the best demographics in the world of all major economies. You can look at the age profile in the top chart. Our penetration of consumer durables, let's say cars, is the lowest in the world. So what that means is that the potential for growth in India is by far the largest. We are the biggest beneficiary of oil prices fall. So our oil imports to GDP is 5%, which is highest amongst all the large economies. So our savings should also be the maximum. India is one of the few economies where deflation is still not a concern. So RBI governor a few weeks back, he said he is still worried about inflation. But most countries in the world fear deflation. Inflation is a lesser evil than deflation, because deflation is extremely hard to come out of. And if you look at the last row, it gives you the interest rates in different economies. So it is one of the very few economies in the world which still has peak interest rates. So whether in Europe, in Japan, in US, interest rates are close to 0 to 2%. They have to move up at some point of time. But India is in a unique position that our interest rates have a long way to fall. So, and that's why we feel that this is very relevant for foreigners, for someone who is sitting outside India, that what are the prospects of India. So I think long term in India was always good. But today if you compare India with countries outside India, we are looking to be the best placed economy probably. I think government has taken a lot of very interesting initiatives. And let me just point out 2 or 3. I mean, to open 10 crore bank accounts in 6 months is equal to what we have done in 60 years. If every Indian family has a bank account, you can transfer all subsidies by cash. So you can over time subsidize only the deserving families, only the poor families. So it has huge implications for LPG, kerosene, over time even power and fertilizer subsidies can move through this. So I think that shows the speed of execution. The demand for gold could moderate. If people can save small amounts in banks and earn interest, the need to save in gold can reduce over time. I think few more, this mining, government has passed a mining ordinance bill. So going forward, all mines will be auctioned to the private sector. So we have had a lot of controversies surrounding allocation of mines, coal mines, iron ore mines, bauxite mines. I think all that will be a thing of the past. There are many more, it's a fairly long list, but I think when we look at the initiatives of this government, we find very good understanding of problems, very smart solutions and very quick execution. Coming to equity markets, you can see markets are of course done quite well, but the P's are still very reasonable. So the blue line is the P multiples. So you can see the P's are around 17 times. And this is happening at a time when the net profit margins of companies are at a 16-17 year low, the table at the right. And therefore, when profitability is at a cyclical bottom with reasonable P's, I think the outlook for equities is quite good. But I think with markets at 16-17 P's, I would not recommend investments in equities with a less than 2 year view. But if you have 2 year and longer view, I think equities are a good investment. Many people think index is up sharply in last 1 year, but what they forget is in last 6 years, it is up only 30%. So in Jan 2008 till date, index is up 30%, but in 6 years, the nominal GDP of the country is more than 100% up. So we should focus also on what the markets have done in 6 years and not just on the last 1 or 1.5 years. I think what is also interesting is that all indicators of interest rates are pointing downwards, and we have been suggesting this for over a year, that even long bond funds, gilt funds, corporate bond funds are also a very good asset class. So whether you look at inflation, current account, fiscal, or even US interest rates, the gap between India and US interest rates is at an all-time high. So Indian rates are 7.8, US rates are around 1.8. So the gap is 6%. This gap is at a record high. So even if US interest rates have to go up, we think there is room for interest rates in India to fall further. So I think we are in a good situation. The outlook for both Indian equities with a 2 year or longer view and outlook for long bonds in India is quite positive. I think the real rates, if you focus on the table at the right, the chart at the right, it tells you the gap between 10-year bond yields and inflation is close to all-time high levels. And this is what suggests that Government of India is unlikely to give us more than 1.5% real yield. Right now the real yields are much higher. So over time the 10-year yields in India should move lower still. This is again in the global context. If you see the rates, interest rates pre-Lehman crisis across major countries, and today you will find that every single country other than India, the rates have collapsed and they are between 0 to 2%. So India is again standing out, and this is what I was suggesting to you earlier, that in India we are sitting near peak interest rates. So we are one of the very few countries in the world where interest rates have to move lower. I think this is a very pet slide with me, and this is a very informed audience, but let me just spend 30 seconds on this slide. This gives you the returns of gold and of equities and of bank FDs over last 35 years. You can see that in Sensex, money has become 280 times in 35 years. In gold and bank FDs, it is up only 20 times. So bank FDs and gold are compounding at 9% per annum. Equities are compounding at 15% per annum. So there is a very strong case in India to park your long-term savings into equities, because our nominal GDP is growing at 15%, and that is what equities are also doing over long periods. And you can see the difference between 9% CAGR and 15% CAGR makes a difference of 10-15 times to your wealth over a lifetime. So by not investing in equities, we are actually missing out on a lot of potential returns. And what is also interesting is, if you look at the returns of gold, gold returns are very volatile. So there are 3, 5, 7-year periods where gold also does not give you returns. So if you can be so patient, if you can be so tolerant of volatility as gold with a 9% return, why not tolerate the same volatility, the same long-term view? Why can't you bring it to a 15% asset? So I think gold is not good, neither for volatility, neither for certainty of returns, nor for returns. So while bank FDs are secure, they give you time-bound returns, gold does not do that. So I think there is a very strong case to move assets from gold into equities. In fact, we feel that equities are the real gold. And let me share with you this one last slide. This slide gives you the ownership of Indian stock markets by foreigners. So in 1991, FIIs used to own 0% of Indian equities because they were not allowed to own. In 2002, they owned 10 or 12% of Indian equities. So every year they were buying 1%, and today they own 24% of our stock markets. So in 22 years, their ownership has gone from 0 to 24%. So on an average, they are buying 1% of Indian stock markets every year. Why are they doing it? They are doing it, if you look at the table at the chart at the bottom, the gap between India's GDP growth rates and world GDP growth rates is very high. So the higher the growth, the more attractive are the equities, and this is why they continue to buy into Indian equities. When we sell 1% of our stock markets, the locals have been selling, we get dollars. And what are we doing with these dollars? We are buying gold, because gold is also imported. So in a sense, we have been selling every year 1% of our equities, a 15% CAGR asset, and switching that into a 9% CAGR asset. India is a poor country. I don't think we can afford to be so charitable. So I think this is it. This is what I wanted to share with you. One last slide. HDFC Equity Fund has completed 20 years this month, and we have seen both good and bad times. But in this journey of 20 years, 10,000 rupees has become nearly 5 lakhs, and in the stock markets it is up only 7 times. So we have also had challenging periods like anyone else, but I think our discipline, our focus on long term, focus on quality, focus on not overpaying for businesses has made this possible. So thank you very much for a patient hearing. This is what I wanted to share with you. Thank you.
Are there any questions? Yeah, bring them out. Okay, I'm asking you a question. Though you addressed part of it, maybe you'd like to re-emphasize it. All macro indicators are looking good due to fall in crude. Will everything look as good when crude bounces back?
See, last year our crude oil import was at $107. India was looking good even then. Crude oil prices were $20 in 2003. They moved up from $20 to $100 over 10 years, but India did not stop growing. So India was looking decent even in last year with crude at 100, but the pace of the fall in oil prices will accelerate the progress. That's all. But it is not that if oil goes to $70 or $80, the outlook in India will become dark. It will become less rosy. But please understand, at $105 last year, we still grew 4.7%. I think the fall in oil leads to faster fall in interest rates, faster recovery of growth. If oil prices go up, we will recover a little later, but I think we will still recover. Yes.
Okay, Prashant, your view on mid-cap and small-cap for the next 5 years?
I think if you look at very long periods, there is no sustainable return gap between mid caps and large caps. Even though logically, and some funds have delivered, mid cap funds tend to deliver higher returns because you can buy smaller businesses, less discovered businesses. However, as on date, I think there is no material and no widespread discount in valuations of mid caps compared to large caps. So I think the higher returns that we have experienced in last few years in mid caps over large cap funds, I think that is unlikely to sustain. So longer term, I think it is good.